For the good, the bad and the outlook for super savings, I spoke to Warren Chant. He's the director of Chant West, a highly regarded company which monitors and rates super and pension funds in Australia. Warren Chant, thank you very much for your time.
Pleasure.
Has it been a good year for super funds?
It's been a fantastic year for super funds. I mean, despite the share market turmoil in the last few days and the Greek crisis, super funds, the typical growth fund, typical super member, can expect something like 9.5% this year. Typically, we say over the very long term, if you get between 6 and 7%, that's a really good return over the long term. So 9.5% is a very good year.
Which funds have been the best performers and what assets have they held to get them there?
Okay, the best performing funds are those that have held more listed securities, so shares and property, than unlisted securities, and those that have invested overseas and haven't hedged that. So because the $A fell, that's had a very positive effect on returns on international shares. So of that 9.5%, 3% has really come from unhedged returns. So if you had a good exposure to overseas shares and you didn't hedge that, then you did particularly well.
And who've been the worst performers this financial year?
Well, it would be the opposite. And those that have had more in unlisted assets. So there will be many funds have a very high exposure to listed assets, so between 25 and 35%, and they won't have performed as well as the funds that had a very high exposure, say in the 50s and 60% to listed assets.
Has there been a difference between industry and retail super fund performance?
Look, there's a lot of debate about this. Over the long term, so we say 10 to 15 years, industry funds have clearly outperformed the retail funds by about 0.75%, so 75 basis points. But in the last 7 years, so since the GFC, or the last 6 years since the GFC, listed markets have performed particularly well compared with unlisted assets, and retail funds hold more listed assets than industry funds. So their performance over the last 6 years, industry funds and retail funds, has been pretty much line ball. There hasn't been much in it.
What about risk profiles? Have those workers who have opted for higher risk exposed funds, has that decision paid off?
Yes, it has. So we're saying that typically, so the typical superannuation fund investor is invested in a growth fund, and that's, we think that'll earn about 9.5%. So those that invested in a high growth product, that's about 10.5%. So yes, it has paid off for them. And indeed, the last 6 years it has paid off for them.
When you say high growth, that essentially means higher risk. Is that position going to pay off in the coming financial year, considering what we're seeing at the moment with Greece and Europe, the fact that the US Federal Reserve is likely to hike rates, and potentially we're going to see a big correction in the Chinese market as well?
It's a very good question, and it's very difficult to answer that question. Over the long term, what we call higher growth funds, so we're saying there that those funds invest about 85% of their assets in shares and property, versus a growth fund where it's more like 75%, okay, 70 to 75%. So over the long term, you expect, because you're taking more risk, you expect to get rewarded for that. So over the long term, you expect that to pay off. So when you're looking at short periods of time, things can be very different. So you've asked the question of, well, over the next 12 months, we've got a lot of uncertainty at the moment, etc. But whilst there's a lot of uncertainty at the moment, there's still a lot of, if you look at the bigger picture, the global economy is chugging along reasonably well. There's some bright spots and some not so bright spots, but on average, things are looking pretty good. And share markets have performed really well in the last 6 years because central banks have artificially kept interest rates low. By and large, that's still the case, right? So the issue is, there are some negative things to be concerned about at the moment, but there are some macro things that make you think, well, share markets could perform more normally over the next 12 months, and it would be, if that were the case, you would be better off in one of those higher growth products.
The overseas assets that have been held by the best performing funds this year, are those assets going to continue to pay off in the coming financial year?
Well, as I said, one of the reasons that we've had such good performance this year, so of that 9.5%, I've said 3% came from being unhedged in global markets. And that was because there was a significant fall in the Australian dollar from 94 cents to 77 cents. So is that going to happen in the next year? It's unlikely that that's going to happen. So do we expect the returns from global shares to be as great unhedged? No, we don't. So the return this year for unhedged global shares is 26%. It's unlikely that's going to happen, but it could, of course.
Turning to fees, which is always controversial in the super space, has there been any reduction as competition grows?
When we talk about fees, we tend to talk about fees in MySuper. So there's two types of superannuation product. MySuper, which is for compulsory, and then there's choice. Most people are in MySuper, so most people don't elect to make a choice as to where their super is. So in the MySuper world, we think that fees are very reasonable, right? And sort of the government has achieved its aim of attracting in those products relatively low fees. Now there are always people who say they should be lower, right? So there are very important figures in the industry who say even those fees should be lower, but they would like to see the fees of fund managers come down. The problem is, fund management is a worldwide industry, and while funds would like to see the fees come down, the fees are what they are. If they can't get them any lower, then that's the market. So in other words, while a number of commentators say fund managers take too big a share of the cake, the biggest funds in the land, 90 billion and 50 billion and 30 billion, they're doing their best to negotiate their fees. So you have to say that the fees that they pay are as low as they can possibly get given the market. So we think that fees are, in that MySuper space, most Australians are paying very reasonable fees for their super.
What about outside the MySuper space?
Well, outside of the MySuper space, so in the world of choice, people that go into the world of choice tend to want to have a lot more investment choice. They want to have a lot more involvement with their super, and generally that costs more money. So choice products tend to be more expensive than MySuper products. But people, that's their choice to pay that. And presumably they're paying that because they want the extra flexibility in investment, and they want the extra services that come with those choice products. But it's their choice, they don't have to do that.
Are these fees coming down though?
They're coming down as well. I mean, there's no question that the MySuper market is the biggest market by far. And it's very difficult for the choice market to ignore the MySuper market. So there's no question that fees in the choice market have been affected by the lowering of fees in the MySuper market.
So better returns?
Yeah, it makes returns better.
The government has recently launched its push to get more independent directors on the boards of industry funds. Is there a need for this? Have returns been hampered by the makeup of boards in the past?
Look, governance, we talk about governance, so how you manage the process. So we're saying that governance is a really important issue, and to get good investment returns, you need good investment governance. Okay, so no one really disputes that. It's very hard to say exactly how good governance, it's very hard to quantify how good governance translates into better returns. I think the real issue with independence is more, in our industry, we have, in MySuper, we have 120 products. That's way too many. And so you read a lot about amalgamation, that funds should be amalgamating and they should be getting the benefits of scale. When you've got a 50-50 system, as we do with most industry funds, it's very hard to have change. It's very hard to get them to amalgamate. So in a sense, having 1/3 of the directors being independent does help that amalgamation process. The other thing is that we're now getting funds, they're becoming very, very large. So Australian Super's 90 billion, Uni Super's 50 billion, First State Super's 50 billion. There are several in the 30 billion. So they're significant businesses in their own right. And the issue is, when you become, when you're becoming very large businesses and you're so important to the Australian economy, then should the standards, the governance standards, be higher than what they've been in the past? And we think there's a good case for that.
Warren Chant, thank you very much for joining the program.
Pleasure.